EMA versus SMA, exponential moving average versus simple moving average. Which one wins? Which one do you love the most? Have you used EMAs or SMAs in your own trading? Which one has worked better for you? So this is a question that I got from one of the viewers on the channel, just asking which one is better, EMAs or SMAs? Leave your thoughts and comments in the comment section below so that we help out a friend. If you've been using EMAs and SMAs as well, give reasons why you love the other over the other. So, EMAs or exponential moving averages and SMAs, simple moving averages, are basically tools or indicators that we can use to track price trends on a chart. And remember, they cannot predict the future because they are lagging indicators, which means they only print after price has moved. So uh, that's something that you just need to note. By the way, if you are looking for a reliable forex broker, if you're looking for a reliable forex broker for your trading or synthetic trading, see the links in the description box below. I've used these brokers for more than 5 years now, and they've basically been very reliable in terms of deposits and withdrawals, no issues whatsoever. So I'm not afraid of recommending them. So see the links in the description box below. Okay, so getting back to our video, between EMAs and SMAs, which one offers the better signals? Which one offers the better signals? So let's first look at the differences. What's the differences between the EMA, exponential moving average, as well as the SMA, the simple moving average? So the EMA basically reacts faster to any price changes on your chart, whereas the simple moving average, SMA, smoothes out the price over time. The EMA gives more weight to recent pricing, whereas the simple moving average basically treats prices equally. The EMA is better for short term trading. There's always a debate about what's short term trading and what's long term trading. So, short term trading is people who are trading, 1 minute time frame up to um, 15-minute time frame. If you ask some people also tell you up to an hour. That's considered short-term trading. For others, is the 4 hourly chart going upwards. That will be the long-term trading. So it differs. People have got various definitions of what's short-term trading and what's long-term trading, but think of short-term trading as day trading and long-term trading as swing trading and this sort. So EMAs, they are very good for short-term trading, and SMAs are better for long-term trading, where you are going to be looking for longer period trends. You want to use the simple moving average. So the EMA, basically what it does is it tries to catch the quick moves, while the SMA actually tries to avoid any false signals that you might actually have on your chart. So again, you choose what you want. Do you want quick moves, quick signals, or do you want something that has been smoothed out and you basically try to avoid false signals? So that's probably some of the differences. Of course, because of that, because the EMA is very reactive, it means it's more sensitive to price movements, whereas the SMA, the simple moving average, is more stable. So here's what people love about EMAs. They quickly respond to price movements. The moment price shifts, the EMAs quickly responds to the price move. So they are very good for day trading. and short-term trading, because basically shadowing the price as it moves. They also help you to catch up the breakouts very early, and they work well in volatile markets. If you're trading synthetics, and if you're trading things that are volatile like gold and silver, you want to use EMAs. They love volatile markets because they can quickly respond to price moves. And they're also easy to combine with various other tools. And let's also look at the downsides of EMAs. If there's a good, there's always a bad side around something. So the one problem with EMAs is they are too sensitive to prices. So sometimes there's a tendency of giving you false signals. So if you're going to rely on EMAs, just know that they are very sensitive to price movements, which means you might end up with some false signals, and which means that you might need an extra indicator, an extra rule to filter out the bad signals that you're getting from the EMAs. And they tend to whipsaw around in sideways markets. When the markets are not moving and the markets are just sideways, sometimes the EMAs tend to just whipsaw around and you can't even tell what's going on. So they they are harder to use just by themselves. That's what I'm trying to drive at here. It's hard to just use the EMAs just by themselves. You probably need an extra indicator that you can also use if you're going to be using EMAs. Yes, what people love about simple moving averages, SMAs. Of course, they are very simple to understand, like all EMAs are, and they are very reliable in calm markets because they try to smooth out the trend. So when a market is just calm and is flowing, and there are no violent whipsawing and massive candles and the sort, the simple moving average is a very good measure or indicator to use when you are trading. So it's usually used for long-term trading. People who are planning to hold trades for longer time. So that's why I said when I started this video, people who are trading above 1 hour, 4 hour daily time frames and the sort, you can actually rely on the simple moving average because it smooths out the trends, unlike the EMAs. So it also helps you to spot the support and resistance because it filters out any noise. So that's what people love about simple moving averages. But what we'll also hate about simple moving averages, again, we're looking at both sides of the river. They are very slow to react. I Simple moving averages, they are very late to the party. They are not like exponential moving averages, which quickly react to any price movement. The simple moving average basically waits a bit and has to process the price movement and smooth it out, balance it out with the previous price movements to create a smooth trend line, or whatever you want to call it. So they're very slow to react to price movements, which means if you're trying to catch any fast moves in the market, you end up actually missing them. They do lag a lot behind the price, so they are not reliable for people who love short-term trading. Scalpers, you can't scalp with SMAs. If you're going to be scalping, rather use the EMAs. So that's what people don't like about simple moving averages. So in conclusion, let's just decide on this. There is no right or wrong answer here. Which one wins between the EMA and the SMA? There's no right or wrong. It depends on what kind of a trader you are. EMA, they win in terms of speeds. If you are looking for something that quickly reacts to the market and gives you a signal, then you go with the EMA. But if you are looking for something that is more stable, that gives you a more stable trend, then your choice will be the SMA, the simple moving average. So the EMAs, we want to use them for action, and the SMAs, we want to use them for like patiently following the trend. Most traders, what they do is they use both. Most traders that I know also use both, some combination of a simple moving average as well as an exponential moving average. And they also try to combine them with other indicators so that they filter out any false signals. So there might be some benefit out of combining the two. So which one wins, the EMA or the SMA? It depends on what kind of trader you are. Are you a short-term trader or are you a long-term trader? If you are a short-term trader, then definitely there's no way around it. Use EMAs. But if you are a long-term trader, you have no choice, but you have to use the simple moving average. What are your thoughts? Leave them in the comment section below. Let's help out each other. See you in the next video. Bye.